Before we dive in, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information in this video is not intended as, and shall not be understood or construed as financial advice. Investing in real estate involves risk, and you should always conduct your own research and consult with a qualified professional before making any investment decisions. Let's be honest for a second. You're probably on what feels like a financial treadmill. You work a 9-to-5, you put money into your 401k, you save what you can, and you watch your net worth inch up at a snail's pace. You follow the traditional rules, but deep down, you know that path won't lead to true financial freedom. It's the path to retiring at 65, hoping your money lasts. But what if there was another path? What if there was a system, a blueprint, that the wealthy have used for over a century to get off that treadmill and build a river of cash that flows into their bank account every single month, whether they're working, sleeping, or on vacation? That system is multifamily real estate investing. And over the next 10 parts of this series, I am going to give you the complete beginner's roadmap to get started. We are going to demystify the entire process, from finding your first deal to cashing your first rent check. This isn't about flipping houses for a quick buck. This is about building real generational wealth. This is about buying back your time. Now, you might be thinking, multifamily? You mean apartment buildings? That's for millionaires. I can barely afford a down payment on a regular house. That is the single biggest myth holding people back, and we are going to shatter it. You'll be shocked to learn how you can get into your first multifamily property, a duplex or a triplex, for oftentimes the same or even less money down than a traditional single-family home in the same neighborhood. The difference? The single-family home is a liability, costs you money every month. The multifamily property is an asset. From day one, it pays you to live there. Let me paint a picture for you. Let's call it the tale of two landlords. Meet Sarah and Mike. They both have the same amount of savings, the same good credit, and the same dream of investing in real estate. Sarah takes the conventional path. She buys a nice 3-bedroom single-family house for $400,000. Her mortgage, taxes, and insurance come out to about $2,500 a month. She finds a great tenant and rents it out for $2,800 a month. After accounting for a little bit for future repairs and vacancies, she's making about $150 a month in pure cash flow. Not bad, right? She's a real estate investor. But then the tenant's job transfers them out of state, and they have to move. Suddenly, Sarah's property is vacant. Now, not only is she not making that $150, she has to pay the entire $2,500 mortgage out of her own pocket. One vacancy, a single stroke of bad luck, and her asset has instantly become a massive liability. She's stressed, scrambling to find a new tenant, and her investment is bleeding cash. Her business is operating at 100% occupancy or 0% occupancy. There is no in-between. Now let's look at Mike. Mike takes a different approach. He finds a duplex, 2 separate units under one roof, for the same price, $400,000. Because it's a multifamily property, he can use a special type of loan, and his mortgage, taxes, and insurance also come out to around $2,500 a month. Each unit in this duplex can rent for $1,600 a month. So Mike rents out both units. His total income is $3,200 a month. His total expense is $2,500. After setting aside money for future repairs, he's cash flowing over $500 a month. Right off the bat, his single investment is generating more than 3 times the cash flow of Sarah's property. But here's where the magic happens. One of Mike's tenants gets a new job and moves out. Just like Sarah, Mike has a vacancy. But is he panicking? No, because he still has $1,600 coming in from his other tenant. That one rent check is enough to cover a huge chunk of his $2,500 mortgage. Instead of being $2,500 in the hole like Sarah, Mike only has to cover a much smaller shortfall while he finds a new tenant. His business is operating at 50% occupancy, not 0. He's insulated from risk. The power of scale, even on this small level, creates a massive safety net. And this is just the beginning of the advantage. When it's time to get the property appraised, the value of Sarah's single-family home is based on what similar homes in the neighborhood have sold for. She has no control over it. But the value of Mike's duplex? It's valued like a business. Its worth is based on the income it generates. By making small improvements to the units and increasing the rent by just a little bit, Mike can literally force the value of his property to go up, regardless of what the rest of the market is doing. He is in control. Sarah owns a house. Mike owns a small business. That is the fundamental difference. And that is why we are focusing this entire series on multifamily investing. Over these 10 parts, we are going to build your knowledge from the ground up, focusing on what I call the 4 pillars of multifamily success. Pillar 1 is the deal. This is all about finding and analyzing properties. How do you find a duplex like Mike's? How do you run the numbers in 5 minutes to know if it's a winner or a dud? How do you spot hidden potential that other investors miss? We will give you the exact tools and formulas to analyze deals like a pro, even if you hate spreadsheets. Pillar 2 is the money. This is where we shatter that myth that you need to be rich. We'll explore the world of creative financing, from FHA loans that let you buy a 4-unit property with just 3.5% down, to house hacking where your tenants pay your entire mortgage, to partnering with other people to fund your first deal with none of your own money. Pillar 3 is the management. A great property with bad management is a nightmare. We'll cover how to find incredible tenants who pay on time and treat your property like their own. We'll talk about setting up systems to automate rent collection and maintenance requests, so the property serves you, not the other way around. This is how you build a passive income machine instead of buying yourself a second job. And finally, Pillar 4 is the growth. This is about scaling your portfolio. How do you take the cash flow and equity from that first duplex and leverage it to buy a 4-unit, then an 8-unit, then a 16-unit building? This is the path to true financial freedom, and we'll lay out the step-by-step strategy to get there. You don't need a license, you don't need a ton of cash, and you absolutely do not need to be a real estate genius to get started. What you need is a blueprint, a proven process to follow that removes the guesswork and a lot of the risk. That is what this series is designed to be for you. This is your masterclass. So the question isn't if you can do this. The question is, are you ready to learn how? We're about to unpack the very first and most important pillar: how to find and analyze your first deal. Because all the money and management skills in the world are useless if you can't find a property worth buying. We're diving deep into the strategies the pros use to find deals before they ever hit the public market. So let's talk about the single biggest mistake new investors make. They open up Zillow, they go to LoopNet, they look at the big commercial real estate websites, and they start window shopping. Feels productive, right? You're seeing properties, you're looking at pictures, you're crunching some numbers. But here's the brutal truth. You are looking at the leftovers. The deals that have been picked over, passed on, and professionally packaged for the masses. Think about it. By the time a property hits one of these major public websites, it has been seen by hundreds, maybe thousands of professional investors. The seller's broker has blasted it out to their exclusive list of A-list buyers. The best deals, the ones with the most potential, the true hidden gems, they get snatched up long before you ever even knew they were for sale. Relying on public listings is like trying to find a treasure chest in a public park with 1,000 other people who all have metal detectors. The odds are stacked against you from the start. The real wealth in multifamily isn't found, it's created. And that creative process starts with finding off-market deals. Off-market simply means the property is not publicly listed for sale. The owner isn't actively marketing it. This is where the magic happens. These are the deals where you're not bidding against a flood of competitors. You're not dealing with an inflated price that's been set to create a bidding war. You are often dealing directly with an owner who might have a problem you can solve. Maybe they're a tired landlord. Maybe they inherited the property and have no idea how to manage it. Maybe they're facing a financial crunch. These situations create opportunity. Your job isn't to be a real estate browser. It's to become a real estate detective, an opportunity hunter. And there are 4 primary weapons you're going to use to hunt down these deals. The first and most powerful is building relationships with commercial real estate brokers. Now I know what you're thinking. Didn't you just say brokers list properties on public websites? Yes, but that's not the whole story. The best brokers have a deep network and they know which owners in their market are thinking about selling months or even years before they're ready to list. They have a pocket list of deals. Your goal is to get on that list. But you can't just call up a broker and say, "Hey, find me a good deal." They get that call 100 times a day from people who aren't serious. You need to approach them like a professional. You need to position yourself as a credible, decisive buyer, even if you're just starting out. Here's how you do it. First, you identify the top multifamily brokers in your target market. Look at who has the most listings, who is closing the most deals. These are the players. Then you craft a professional email or make a call. You introduce yourself, and you present your buying criteria with absolute clarity. Don't say, "I'm looking for a multifamily property." Say, "I am actively looking to acquire a 10 to 30 unit, Class C apartment building in the Northwood neighborhood, built between 1970 and 1990. I'm focused on properties with value-add potential, specifically deferred maintenance or below-market rents. My target purchase price is between $1 and $3 million." See the difference? That level of specificity tells the broker you've done your homework. You're not a tire kicker. You are a serious buyer who knows exactly what they want. It allows them to immediately filter through their mental database of properties and owners to see if there's a match. Follow up consistently, maybe once a month, not to bug them but to stay top of mind. Ask them smart questions about the market. Buy them coffee. Build a real relationship. When that perfect off-market deal surfaces, a seller who says, "I need to sell quietly and quickly," who do you think that broker is going to call first? The random person who emailed them once? Or the professional, specific, and persistent buyer who has built rapport? That's how you get the first look. Your second weapon is a classic, but with a multifamily twist: driving for dollars. This is old school, boots-on-the-ground detective work, and it is shockingly effective. You literally get in your car and drive through the exact neighborhoods you identified in your buying criteria. But you're not just sightseeing. You are looking for signs of opportunity, which are often signs of neglect. What does that look like on a multifamily property? You're looking for faded, peeling paint, overgrown landscaping and weeds in the flower beds, a parking lot full of potholes, a roof that looks like it's seen better days, multiple window unit air conditioners, which can be a sign that the central HVAC system is shot. Look for handwritten for rent signs with a local phone number. This is a massive clue. It often means the property is managed by the owner themselves, a classic mom-and-pop operator, not a professional management company. These are the exact people who often become tired landlords, overwhelmed by the work and ready to sell to the right person who makes it easy for them. When you spot a property like this, you don't just drive by. You pull over. You write down the address. You take a picture. You're building a private, curated list of potential off-market deals that nobody else has. This list is pure gold. Which brings us to your third weapon: strategic direct mail. Once you have your list of properties from driving for dollars, how do you reach the owners? You could try to look them up and cold call them, but many of the best potential sellers are older and don't respond well to that. A well-crafted letter, however, can work wonders. You can find the owner's name and mailing address through county public records, or by using a simple online tool like PropStream. But you can't send a generic, "I want to buy your property" postcard. It'll go straight in the trash. Your letter needs to be personal, professional, and solve a problem. It should be on quality paper, maybe even handwritten or using a handwriting font. It should say something like, "Dear Mr. Smith, I'm a local investor specializing in apartment buildings on Elm Street. I was admiring your property at 123 Main Street the other day and was wondering if you've ever considered selling. I know managing a property can be a lot of work, and I focus on making the sales process incredibly simple and straightforward for owners who might be looking to retire or free up their time. If you're even remotely curious about what a simple, no-hassle offer might look like, please feel free to give me a call." This approach is non-threatening. It positions you as a problem solver, not a predator. You might send out 100 of these letters and only get 1 or 2 calls back. But that one call could be the 7-figure deal that changes your life. It's a numbers game, and you're playing it smarter than everyone else. Finally, your fourth weapon is your network, your deal team. You need to become a walking billboard for what you're looking for. Tell everyone you know, but more importantly, tell the right people. Who else comes into contact with distressed properties or motivated sellers? Property managers are on the front lines. They know which owners are tired, struggling to make repairs, or constantly complaining about tenants. A good property manager is an incredible source of off-market leads. Who else? Plumbers, electricians, roofers, and other contractors. They are inside these buildings every day. They see the leaky pipes, the faulty wiring, the deferred maintenance. They know which owners are paying their bills late and cutting corners. Build relationships with these tradespeople. Let them know you'll pay a finder's fee for any lead that turns into a closed deal. You'll be amazed at what they bring you. Talk to real estate attorneys and CPAs. They advise clients on estate planning and financial hardship, 2 major reasons people decide to sell. The key to all of this is a fundamental mindset shift. You must stop waiting for deals to appear and start actively hunting for opportunities. Finding a great multifamily deal is a contact sport. It requires proactive, consistent effort. It's about building a system, a deal-finding machine that runs continuously, turning over rocks and looking in the dark corners of the market that others ignore. It's work. But this is the work that separates the amateur investor from the professional wealth builder. Now you have the tools to build your pipeline and find those hidden gems. But finding a potential deal is only half the battle. How do you know if it's a diamond in the rough or a money pit in disguise? How do you look at a building and, in less than 5 minutes, know if it's even worth a second look? In the next part, we're breaking down the exact numbers, the back of the napkin math that separates the pros from the amateurs, and I'll give you the one spreadsheet that will change the way you look at real estate forever. Alright, let's pull back the curtain. Forget everything you've heard about the 1% rule, or other quick and dirty tricks you might use for a single-family house. In the world of multifamily, that kind of thinking will get you eaten alive. A 10-unit building isn't just 10 houses stuck together. It's a business. And you have to analyze it like a business owner, not a homeowner. The first number, the one that everything else is built on, is the net operating income, or NOI. This is the heartbeat of the property. It's simple, but it's the most lied about number in real estate. The NOI is all the money the property brings in, its gross income, minus all the money it costs to run it, the operating expenses. And I mean all of them. We're not talking about the mortgage yet. The mortgage is your loan. It has nothing to do with how well the property itself performs as a standalone business. We're talking about the real gritty costs: property taxes, insurance, utilities that you, the landlord, have to pay like water or trash. We're talking repairs and maintenance, and you better budget for this because stuff will break. We're talking landscaping, pest control, and a big one people forget: vacancy. No building is 100% full 100% of the time. People move out. It takes time to clean the unit, list it, and find a new tenant. You have to account for that lost rent. A conservative estimate is usually 5 to 8% of your potential gross income just gone. Poof. And finally, property management. Even if you plan to manage it yourself, you pay yourself. Your time isn't free. A typical management fee is 8 to 10% of the rent collected. So, you add up all that income, mostly rent but maybe some laundry coin machines or paid parking, and you subtract all those operating expenses. What's left over is your net operating income, your NOI. That number is the pure, unadulterated profit the building generates before any loans are paid. It is the truth. Now, why is this number so important? Because it lets us calculate the second magic number, the capitalization rate, or cap rate. The cap rate sounds intimidating, but it's just a way to compare different investments. All it is the NOI divided by the purchase price. So if a building has an NOI of $50,000, and the seller is asking $1 million for it, you have a 5% cap rate. Think of it like this: if you paid all cash for that building, $1 million straight from your bank account, you would earn a 5% return on your money that year. $50,000 in profit on your $1 million investment. The cap rate lets you look at a 5-unit building in Texas and a 50-unit building in Ohio, and compare them on an apples-to-apples basis. A higher cap rate generally means a higher return, but often comes with higher risk. A lower cap rate usually means lower return, but it's probably a safer, more stable property in a prime location. In the world of multifamily, you don't say, "I'm looking for $1 million building." You say, "I'm looking for a 6 cap in a B-class neighborhood." It's the language of the pros. But here's the thing. Most of us aren't paying all cash for $1 million property. We're getting a loan. And that's where the third, and for you the most important metric comes in: cash-on-cash return. This is your report card. This number answers the only question that really matters to your bank account. For every dollar I actually pull out of my pocket and put into this deal, how many dollars do I get back each year? Let's walk through a real-world example. A 10-unit apartment building. The seller is asking for $1 million. Each unit rents for $1,000 a month. That's $10,000 a month in rent, or $120,000 a year in gross potential income. Now the seller's brochure might stop right there and say, "Look, $120,000 a year." But we're smarter than that. We know we have to subtract our operating expenses. Let's use a common rule of thumb for initial analysis, the 50% rule. We'll assume that half of our income, $60,000, will be eaten up by all those expenses we listed. Taxes, insurance, maintenance, vacancy, management, the works. So $120,000 in income minus $60,000 in expenses gives us a net operating income, our NOI, of $60,000. Now we can quickly calculate the cap rate. $60,000 of NOI divided by the $1 million purchase price. That's a 6% cap rate. Okay, not bad. It tells us the property itself is performing decently. But now let's bring in the bank. To buy this $1 million property, the bank wants you to put down 25%. That's $250,000. This is your actual cash in the deal. The bank lends you the other $750,000. Let's say your annual mortgage payments on that loan, your debt service, come out to $45,000 a year. So you take your NOI of $60,000, and now you subtract your debt service of $45,000. What's left? $15,000. That is your cash flow. That is the actual spendable profit that hits your bank account at the end of the year. But what's the return? We calculate our cash-on-cash return. We take that $15,000 in cash flow and divide it by the $250,000 we actually put down. That gives us 6%. So, for the $250,000 you invested, you're getting a 6% return. It's okay. It's better than a savings account, but it's not exactly setting the world on fire. This is where the magic happens. This is why we invest in multifamily. We don't just buy the building. We improve the business. What if, over the next year, we make some simple cosmetic upgrades? A little paint, new light fixtures, maybe some new cabinet handles. And for that, we can raise the rent on each of the 10 units by just $100 a month. $100. Most tenants won't even move for that. But look what it does to our numbers. An extra $100 a month per unit is $1,200 a year per unit. Across 10 units, that's an extra $12,000 a year in pure profit. Because our expenses didn't really go up, this $12,000 drops straight to the bottom line. Our NOI jumps from $60,000 to $72,000. Our cash flow? Well, our mortgage payment is the same. So our cash flow is now $72,000 minus $45,000, which is $27,000 a year. We've nearly doubled our annual profit just by raising rents by $100. And our cash-on-cash return? We take our new cash flow of $27,000 and divide it by our original $250,000 investment. Our return is now 10.8%. We went from a mediocre 6% to a fantastic 10.8% return without putting another dollar into the deal. But it gets even better. This is the part that creates millionaires. Remember how the value of a commercial property is based on its NOI and the market cap rate? Well, the market cap rate is still 6%. But our NOI is now $72,000. So what is the building worth now? We take our new NOI, $72,000, and divide it by the 6% cap rate. The building is now worth $1.2 million. You increase the value of the property by $200,000 just by adding $12,000 to the income. This is called forced appreciation. You didn't wait for the market to go up. You forced it to go up. You created $200,000 in equity out of thin air. This is the superpower of multifamily real estate. Now, running these numbers for every single deal can be overwhelming. You're juggling NOI, debt service, cap rates, returns, and trying to see how one small change affects everything else. That's why I use a deal analyzer spreadsheet. It's the tool I promised. You plug in the asking price, the rent, the loan terms, and it spits out all of these key metrics instantly. It lets you play with the numbers. What if I can raise rents by $50? What if taxes are higher than I thought? You can see the result immediately. It takes all this complex math and makes it simple, turning a mountain of data into a clear yes or no. You now understand the fundamental language of multifamily deals. You know how to calculate NOI, cap rate, and cash-on-cash return. You've seen how forcing appreciation can create life-changing wealth. You have the concepts, but now you need the deals. Where do you find these properties? How do you get in front of sellers before every other investor on the planet does? Because the best deals, the ones that make you rich, are almost never the ones you see listed online. In the next part, we're going off-market. I'm going to show you the exact strategies the pros use to find hidden gems and talk directly to owners, so you can lock up a deal before anyone else even knows it exists. This is the secret world of real estate. It's the equivalent of knowing the password to a speakeasy or having the chef's private cell number. When everyone else is fighting over the same 5 properties on the MLS, paying top dollar in a bidding war, you're quietly having a conversation directly with an owner who just wants to be done. No agents, no competition, no drama. Just a problem and a solution. Your solution. So where do we start? We start with the single most powerful time-tested strategy that has made more regular people into millionaires than almost any other. It's called driving for dollars. And yes, it's exactly what it sounds like. You get in your car, you pick a neighborhood you want to invest in, and you drive. Slowly. You're not looking for sale signs. You're looking for problems. You're looking for signs of a tired landlord. What does that look like? It's the duplex with grass up to your knees. It's the fourplex with a blue tarp strapped to the roof for the last 6 months. It's the building with peeling paint, overflowing gutters, a packed mailbox, or newspapers piling up on the porch. These are not just signs of neglect. They are distress signals. They are flares being shot up by an owner who is likely overwhelmed, out of state, or simply out of cash and out of patience. Every one of those properties tells a story, and your job is to find the ones with a story that ends with you providing a solution. I'll never forget my first one. It was a 3-unit building in a B-class neighborhood. Good bones, but it looked exhausted. One of the front windows was boarded up, and the siding was that sickly green color from years of mildew. I almost drove right past it, but I wrote down the address, and when I got home I did a little digging. I went to the county assessor's website. This is all public information, by the way, and found the owner's name and mailing address. Turns out the owner lived 3 states away. Perfect. An out-of-state landlord with a problem property is one of the most motivated sellers you will ever find. So what do you do with that address? You start a conversation. And the best way to do that is with the most underrated tool in an investor's arsenal: direct mail. Now, I'm not talking about the glossy corporate junk mail you throw away without a second thought. I'm talking about something that feels personal, something that actually gets opened. Think about it. You can send a simple handwritten letter. Something like, "Hi, my name is John. I'm a local investor looking to buy another property in the neighborhood for my family. I was driving by 123 Main Street and was wondering if you might ever consider a cash offer for it. If so, you can call or text me at this number." Put it in a simple non-business envelope. Use a real stamp, not a metered one. Some people even use colored envelopes to stand out. The goal is just to get them to open it and read it. The response rate is low, maybe 1 or 2%. But the calls you get are pure gold. These aren't people testing the market. These are people with a real problem who are now talking to the one person who reached out to solve it. That owner from 3 states away? He called me. He was in his late 70s, he'd inherited the property from his brother, and he was tired of getting calls about leaking pipes and problem tenants he'd never even met. He just wanted it gone. We agreed on a price that was 25% below what similar fixed-up triplexes were selling for. It was a win for him. He got cash fast with no hassles. And it was a massive win for me. That one deal, found by just paying attention on a Saturday drive, created more wealth than years of working a regular job. But driving around isn't the only way. You can supercharge this process by networking with the people who are in the middle of the deal flow. Think about it. Who knows a property is going to be for sale before anyone else? First, property managers. They are on the front lines. They know which owners are sick of the 2 a.m. calls about a clogged toilet. They know who's behind on their mortgage because the rent checks aren't enough to cover it. A good property manager is a goldmine of information. Take one to lunch. Don't just ask them for deals. Ask them about their business. Ask what their biggest headaches are. And then explain what you do. I buy problem properties. If you ever have an owner who's looking for a simple, fast exit, I'm your guy. I can close quick, and I'll even pay you a finder's fee. You just made their life easier and offered to pay them for it. They will remember you. Next, talk to contractors. Plumbers, roofers, electricians, handymen. These are the people who see the problems up close. They know which landlord is just patching a leaky roof instead of replacing it. They know who's trying to fix a 50-year-old furnace for the 10th time. They know who's running out of money. When a contractor gives an owner a $10,000 quote to fix a foundation issue, the owner's next thought is often, maybe I should just sell this place. If that contractor has your card, who do you think they're going to call? And then there are the professionals who deal with life transitions. Divorce and probate attorneys. These situations are unfortunate, but they often force the sale of real estate. A couple getting divorced needs to liquidate their assets. A family inheriting a house from a deceased relative often doesn't want to be a landlord. They want to sell the property, split the cash, and move on. By building a relationship with these attorneys, you become their go-to easy button. You're the person who can step in, make a fair cash offer, and simplify a very complicated and emotional time in their clients' lives. If you want to get even more strategic, you can go straight to the source, public records. This is like digital driving for dollars. Instead of looking for physical signs of distress, you're looking for data that points to it. You can get lists from your county or city for things like code violations. If a building has a dozen violations for electrical hazards or structural issues, that owner is under pressure from the city and is likely motivated to sell. You can look up eviction records. A landlord who is constantly in court trying to get rid of non-paying tenants is losing money and sleep. They are primed for an offer. You can also find lists of pre-foreclosures. These are owners who have been notified by the bank that they are behind on their payments. They are on a clock. They need to sell before the bank takes the property at auction. You can also get lists of owners who are delinquent on their property taxes. If someone can't afford a few $1,000s for taxes, they definitely can't afford a new roof or a boiler replacement. These are all public records. And while it takes some work to get them, these lists are a direct pipeline to some of the most motivated sellers on the planet. Now, I need to pause here for a second because for some people this can feel a little predatory. Contacting people who are in a tough spot can feel like you're taking advantage, but you have to shift your mindset. You are not a predator. You are a problem solver. That owner with the delinquent taxes and the code violations doesn't have an asset. They have an anchor that is dragging them down. That inherited property 3 states away isn't a cash cow. It's a constant, stressful headache. You're not lowballing them. You're offering them a lifeboat. You're providing a fast, convenient exit from a situation that is causing them pain. The price you pay reflects the condition of the property and the convenience you offer. It is a true win-win scenario. They get relief and you get an opportunity. Finding these off-market deals is the single biggest cheat code in real estate investing. It's how you bypass the competition and buy properties with built-in equity from day one. It's the difference between buying a retail product off the shelf and buying directly from the factory at wholesale. Now that you have these powerful, almost unfair strategies to find deals no one else knows about, a new problem emerges. How do you know if it's a good deal? You can find a dozen off-market properties, but if you can't run the numbers correctly, you're just finding a dozen ways to lose money. And that's exactly what we're breaking down next. We're going to build a deal analyzer from the ground up, line by line, so you can spot a home run from 100 yards away and never ever overpay for a property again. Alright, let's build that truth machine. Open up a blank spreadsheet, Google Sheets, Excel, it doesn't matter. This simple grid is about to become your single greatest weapon in wealth creation. Forget the fancy software they try to sell you for thousands of dollars. Everything you need you can build right here, right now. Let's start at the top. The very first number we need to figure out is the absolute, most optimistic, blue sky potential of the property. This is called the gross potential rent, or GPR. It's the total amount of rent you would collect if every single unit was rented out, every single month at full market rent. Let's use a simple example throughout this. Imagine a fourplex. 2 of the units are 2 bedrooms, and 2 are 1 bedrooms. The seller tells you the 2 beds are getting $1,200 a month, and the 1 beds are getting $900. Your first instinct might be to just add that up. Stop. The seller's current rent roll is a piece of history. You're buying the future. Your first job as an analyst is to become a detective. You need to go to Zillow, to apartments.com, to Rentometer, and you need to find out what similar units in that exact neighborhood are renting for today. Maybe you discover that updated 2-bedroom apartments are actually getting $1,400, and the 1-bedrooms are getting $1,000. That's a huge difference. This is called rental upside, and it's a key part of the story of the property. So, for our analysis, we use the market rents. 2 units at $1,400 is $2,800. 2 units at $1,000 is $2,000. Add them together, you get $4,800 a month. Multiply that by 12 months, and you get a gross potential rent of $57,600. That's our starting line. But wait, there's more. Do the tenants pay for their own water? Is there a coin-operated laundry machine in the basement? Are there parking spots you could charge for? Pet fees? Application fees? This is called other income. It might seem small, but it adds up. Let's say the laundry brings in $100 a month, and you charge 2 tenants $25 a month for a reserved parking spot. That's another $150 a month, or $1,800 a year. Don't leave that money on the table. Add it to the gross potential rent. So our new number, our true top line, is $59,400. Let's call this the total potential income. Now for the first dose of reality. No building on planet Earth is ever 100% full for its entire life. People move out. It takes time to clean the unit, list it, and find a new qualified tenant. This is called vacancy. Furthermore, sometimes tenants just don't pay, and you have to go through the painful process of eviction. This is called credit loss. We group these two together and subtract them from our total potential income. The seller might proudly hand you a report showing the building has been 100% occupied for the last 2 years. That's great for him, but it's irrelevant to you. You are not the same manager, the market could change tomorrow, and you must always underwrite conservatively. For most stable B-class apartment buildings, a vacancy and credit loss factor of 5% is a safe, standard assumption. In some tougher neighborhoods, you might use 7% or even 10%. In a red-hot market with a waiting list for apartments, maybe you use 3%. But you never ever use 0. So, we take our total potential income of $59,400 and multiply it by 5%. That gives us a vacancy loss of $2,970. We subtract that from the top line and we arrive at our first major milestone, the effective gross income or EGI. In this case, it's $56,430. This is what you can realistically expect to collect in a typical year. This number is real. This number is honest. But collecting the money is only half the battle. Now we have to pay the bills. This next section, operating expenses, is where the lies are told. It's where lazy analysis gets punished and where fortunes are lost. We need to build our expense list from the ground up, using our own research, not the seller's fantasy numbers. First up, property taxes. This is the single biggest mistake beginners make. The seller will show you what they paid in property taxes last year. This number is completely and utterly useless to you. Why? Because in most states, the county will reassess the property's value based on what you paid for it. And if you paid more than the last guy, your taxes are going up. Period. So you cannot use the seller's number. You have to call the county assessor's office, tell them your potential purchase price, and ask for an estimate of the new tax bill. It's a 5-minute phone call that can save you from a 5-figure mistake. Next, insurance. Same story. The seller's policy is irrelevant. You need your own. Call an insurance broker who specializes in commercial properties, give them the address, and get a real quote. It will be higher than you think. Then we have utilities. Water, sewer, trash, gas, common area electricity. You need to find out which of these are paid by the owner and which are passed through to the tenants. Get the last 12 months of bills directly from the seller. Don't accept a summary. You want the actual statements. Now for a big one, property management. You might be thinking, I'm going to manage it myself so I can put 0 for this expense. Wrong. That's a fatal error. You must always account for a professional management fee, typically between 8% and 10% of your effective gross income. Why? 3 reasons. 1. Your time is not free. You should be paying yourself for the work of collecting rent and fielding calls about clogged toilets. 2. If you ever want to scale up and buy more properties, you will need a manager eventually. Your analysis needs to work with that fee baked in from day one. And 3. When you go to sell the property, your buyer will absolutely factor in a management fee when they analyze the deal. If you haven't accounted for it, your profit projections will be a fantasy, and their offer will be much lower than you expected. So, we'll take our EGI of $56,430 and multiply it by, let's say, 8%. That's a $4,514 management expense. Next, repairs and maintenance. This is for the small stuff. The leaky faucet, the running toilet, the broken doorknob. This is not for a new roof, we'll get to that. A good rule of thumb is to budget between $500 to $750 per unit per year. For our fourplex, let's use $600 per door. That's a $2,400 annual budget for maintenance. And now we come to the silent killer of real estate profits. Capital expenditures or CapEx. This is the big stuff. The roof that lasts 20 years. The HVAC systems that last 15. The water heater that lasts 10. The parking lot that needs repaving every decade. These are not monthly expenses, but they are very real, and they are guaranteed to happen. If you don't set money aside for them, one day you'll get a $20,000 bill for a new roof, and it will wipe out an entire year's worth of profit. You have to treat CapEx like a bill you pay to the building's future self every single month. A standard conservative estimate is to budget between $250 and $400 per unit per year. For our fourplex, let's use $300 a door. That's another $1,200 a year we are setting aside into a separate savings account. Ignoring capex is how you end up with a cash-flowing property that somehow makes you poorer over time. Okay, let's tally it all up. We have our effective gross income. We've subtracted our real-world detective work estimates for taxes, insurance, utilities, management, maintenance, and capex. The number we are left with is the holy grail of property analysis. It is the net operating income, or NOI. The NOI is the pure, unadulterated profit the property generates before you even think about getting a mortgage. It is the heartbeat of the deal. It is the single most important number in this entire process because the NOI, and the NOI alone, is what determines what a smart investor is willing to pay for the property. We've done the hard work. We've stripped away the seller's story, we've ignored the fantasy numbers, and we've calculated the true economic engine of this asset. We have our NOI. But what does this number actually tell us? How do we take this one number and translate it into a knockout offer price? How do we use it to know, with mathematical certainty, whether we're looking at a dud or a grand slam? To do that, we need to introduce the most powerful, most misunderstood, and most argued about concept in all of commercial real estate. It's the simple percentage that connects a property's income to its value. And mastering it is the final key that separates the amateurs from the professionals. It's called the capitalization rate. And that's exactly what we're breaking down next. The capitalization rate, or cap rate for short, is the single most important number in commercial real estate. Forget everything you learned about valuing a single-family house. We're not looking for comps. We're not guessing what a neighbor's house sold for. We're stepping into the world of business, where assets are valued based on one thing and one thing only: the income they produce. The cap rate is the Rosetta Stone that translates a property's income directly into its market value. So what is it? In the simplest terms, the cap rate is the unleveraged rate of return you would earn on a property if you paid all cash for it. Think of it like the interest rate you'd get on a savings account. If you put $100 in an account that pays $5 a year in interest, that account has a 5% rate of return. The cap rate is the exact same concept, just for a building. If you buy a building for $1 million, and after all expenses it puts $50,000 in your pocket each year, that building is generating a 5% return. Its cap rate is 5%. The formula is elegantly simple. Net operating income divided by the property value. That's it. NOI divided by value. We already mastered net operating income, or NOI. That's all the money the property brings in, minus all the operating expenses required to run it. It's the pure pre-tax profit the building itself generates before you even think about a mortgage. The property value is what the building is worth, or what you paid for it. So, the cap rate is simply the ratio between the profit a building makes and its price tag. Let's imagine you're not buying an apartment building, but two different gumball machine businesses. Business A is located in a high-end, secure office park. It costs $10,000. After paying for gumballs and maintenance, it reliably makes $500 a year in pure profit. Your return, or cap rate, is $500 divided by $10,000, which is 5%. Now consider Business B. This one is located in a rougher part of town, next to a bar that gets a little rowdy. It also costs $10,000. But because of the higher traffic and, let's say, a more adventurous clientele, it makes $1,000 a year in profit. Its cap rate is $1,000 divided by $10,000, which is 10%. Which one is the better deal? The 10% cap rate of Business B looks twice as good on paper. You get your money back faster. But what about the risk? The machine in the rough neighborhood might get vandalized. The bar could shut down, killing your foot traffic. The machine in the office park is safer. The income is more predictable. The lower 5% cap rate reflects that safety and stability. A lower cap rate generally implies lower risk and a higher quality asset in a better location. A higher cap rate suggests higher potential return, but almost always comes with higher risk, more management headaches, or a less desirable location. This is the first secret of the cap rate. It's a quick and dirty measure of risk and reward. When you hear an agent say, "Properties in this neighborhood are trading at a 5 cap," and another agent says, "I've got a deal for you over here, it's a 9 cap," you instantly have a mental picture of the two different areas and the types of properties you'll find there. The 5 cap is likely a newer, cleaner property in a great part of town. The 9 cap might be an older building that needs work in a neighborhood that's a bit more transitional. There is no universally good or bad cap rate. It's a reflection of the market, a price tag on risk. Now, here is where the game completely changes. Remember our formula? Cap rate equals NOI divided by value. With a little high school algebra, we can flip that formula around. And when we do, we unlock the single most powerful wealth-building tool in all of real estate. The new formula becomes property value equals net operating income divided by the cap rate. Read that again. The value of your property is directly determined by its income and the prevailing cap rate in the market. This is not an opinion. This is math. And this is where you, as the owner, have godlike power. You can't control the market cap rate. That's set by billions of dollars of transactions happening all around you. But you can control the net operating income. And if you can increase the NOI, you don't just increase your monthly cash flow. You literally force the value of your entire asset to go up. This is called forcing appreciation. And it's how fortunes are made. Let's walk through it. You find a 20-unit apartment building for sale. The seller is a tired landlord who hasn't raised rents in years and mismanages the property. After you do your analysis, you determine the property's current net operating income is $100,000 per year. You also do your research and find that other similar, stable properties in the area are selling at a 5% cap rate. So what's this building worth today? We use our formula. Value equals NOI divided by cap rate. $100,000 divided by 5%, or 0.05, equals $2 million. The market value of that property is $2 million. You buy it for that price. Now you get to work. You're a sharp operator. You notice the rents are $200 below the market rate for similar apartments. Over the first year, as leases expire, you renovate the units with some fresh paint and new fixtures, and you raise the rents to match the market. For 20 units, an extra $200 a month per unit is $4,000 a month in new income. That's $48,000 a year in new gross income. You also look at the expenses. The old owner was paying for a landscaping service that was overcharging him. You find a new, better service for $2,000 less per year. You just cut your expenses by $2,000. So what's the total impact on your NOI? You added $48,000 in income, and you saved $2,000 in expenses. Your net operating income has just increased by a staggering $50,000. Your new NOI is now $150,000. You haven't bought another building. You haven't waited 10 years for the market to go up. All you did was operate the business of your building more effectively. But what happened to its value? Let's run the numbers. The market cap rate is still 5%. That hasn't changed. But your NOI is now $150,000. So, the new value of your property is $150,000 divided by 0.05. The new value is $3 million. Let that sink in. By increasing your annual profit by $50,000, you increase the value of your asset by $1 million. You just created $1 million in new equity, in new wealth out of thin air, simply by being a better manager. This is the magic of multifamily real estate. Every single dollar you add to the bottom line, whether by raising income or cutting costs, is magnified by the market cap rate and converted directly into wealth. That $1 you saved on a water bill isn't just a dollar. In a 5-cap market, it's $20 in new equity. This is why we don't care about comps. A single-family home is worth what someone is willing to pay for it. An apartment building is a business, and it's worth a multiple of the profit it generates. And you are in the driver's seat of that profit. The cap rate is the multiplier. It's the lever that allows you to take a small effort, like installing coin-operated laundry machines or billing tenants back for their water usage, and amplify it into a massive increase in your net worth. Understanding this one concept separates the amateurs from the professionals. Amateurs hope for appreciation. Professionals create it. They see a mismanaged property not as a problem but as an opportunity to increase the NOI and, in doing so, force the value up. The cap rate is their tool. It's their compass for finding deals and their blueprint for manufacturing wealth. But buying a $2 million property isn't something most people can do with cash. The real power comes when you combine this forced appreciation with another tool, a tool that can amplify your returns into the stratosphere. It's a concept Wall Street loves to use and abuse, but when applied responsibly in real estate, it's the jet fuel for your journey to financial freedom. It's called leverage. And learning how to use the bank's money to make yourself rich is exactly what we're covering next. So what exactly is this jet fuel? At its core, leverage is simply using borrowed money, specifically the bank's money, to buy an asset that you couldn't afford with your own cash. Now, using a credit card to buy a big screen TV is bad leverage. It's debt on a depreciating item that produces no income. But using a bank loan to buy an apartment building? That is the definition of good leverage. It's debt on an appreciating asset that produces income. Let's make this real. Imagine a 10-unit apartment building for sale for $1 million. You've saved up $250,000. If you didn't use leverage, you couldn't even make an offer. You're priced out of the game. But with leverage, your $250,000 isn't just $250,000 anymore. It's the key that unlocks the other $750,000 from a lender. You put down your $250,000, the bank funds the rest, and suddenly you control a $1 million cash flowing asset. This is where the magic happens. Let's say over the next year, the property value increases by just 5%. That's a $50,000 increase in value. If you had paid all cash, the full $1 million, your return on that appreciation is 5%. Not bad. But you didn't pay $1 million, did you? You only put in $250,000 of your own money. So that $50,000 gain isn't a 5% return on your investment. It's a 20% return on your actual cash. You see that? You made 4 times the return, simply by using the bank's money. You multiplied the power of your own capital. That is the explosive force of leverage. But it gets even better. Because while the property value is going up, something else is happening every single month. Your tenants are paying rent. That rent money first covers all the property's expenses: the maintenance, the management, the taxes, the insurance. What's left over is your net operating income, or NOI. From that NOI, you then make your mortgage payment to the bank. And whatever is left after that is pure cash flow that goes directly into your pocket. So not only are you getting massive returns from appreciation, but you're also getting paid to hold the asset every single month. Now this all sounds incredible, and it is. But the bank isn't just handing out millions of dollars because you have a nice smile. They are not your friend. They are your business partner. And like any smart business partner, they have a very specific set of rules they play by to protect their investment. Understanding these rules is the absolute key to getting your deals funded. The single most important metric the bank cares about is something called the debt service coverage ratio, or DSCR. It sounds complicated, but the concept is beautifully simple. It's a measure of how easily the property's income can cover its debt payments. The formula is just the net operating income divided by the total annual mortgage payments. Let's go back to our $1 million 10-unit building. Say after all expenses, it generates $80,000 a year in net operating income. And let's say your total mortgage payments for the year, principal and interest, are $60,000. You take the $80,000 in income, divide it by the $60,000 in debt payments, and you get a DSCR of 1.33. What this tells the bank is that for every $1 you owe them in mortgage payments, the property is generating $1.33 in income. That 33 cents is the bank's safety cushion. It's the buffer. If a tenant moves out unexpectedly or the water heater breaks, there's still more than enough cash flow to cover the mortgage and the surprise expense. Most lenders, for a standard multifamily property, want to see a DSCR of at least 1.25. If your number is below that, they see too much risk. If it's well above it, they see a strong, stable investment and are much more likely to give you the loan. You must know this number before you ever talk to a lender. The second metric is one you're probably familiar with: loan-to-value, or LTV. This is simply the loan amount as a percentage of the property's appraised value. If the bank gives you a $750,000 loan on a property that appraises for $1 million, that's a 75% LTV. The remaining 25%, your down payment, is your skin in the game. It ensures you are just as motivated as the bank is to see this property succeed. For most multifamily deals, you can expect to see LTVs between 65% and 80%, depending on the property, the market, and the strength of the borrower. And that brings us to the third critical piece of the puzzle: you, the borrower. The bank isn't just underwriting the property. They are underwriting you and your team. They're going to look at your global financial picture. They want to know your net worth. Do you have other assets? They want to know about your liquidity. Do you have cash reserves in the bank, typically enough to cover at least 6 to 12 months of mortgage payments after you close the deal? This is for emergencies. They want to know about your experience. Have you owned rental property before? If not, do you have a team with experience like a seasoned property manager? You have to remember, you're asking someone to partner with you on a multi-million-dollar business venture. You need to present yourself as a credible, reliable, and low-risk partner. So you found a deal that hits the bank's DSCR and LTV targets, and you've proven you're a strong borrower. You get the loan. The deal closes. Now, one of the most powerful, yet most overlooked wealth-building mechanisms kicks in: loan amortization. Remember that $60,000 annual mortgage payment? A portion of that is interest paid to the bank, but another portion is principal. It's paying down the actual loan balance. In the early years of a loan, most of the payment is interest, but every single month, a little bit more goes toward principal and a little less goes toward interest. Think about what's happening here. Your tenants are paying you rent. You use that rent to pay the mortgage, and that mortgage payment is systematically reducing your debt and increasing your equity, your ownership stake, in this million-dollar asset. Your tenants are literally buying the building for you over time. This happens automatically in the background, month after month, year after year, like a silent wealth-building machine. It's a fourth hidden return stream, separate from appreciation, cash flow, and tax benefits. Now, there are different flavors of loans out there. For smaller multifamily properties, say 5 to 50 units, you'll often work with local or regional banks. They know the area, they're more flexible, and you can build a real relationship with them. Once you get into larger, more stabilized properties, you start to hear about agency debt. This refers to loans backed by government-sponsored enterprises like Fannie Mae and Freddie Mac. These are the gold standard. They often offer the best terms, long amortization periods, lower interest rates, and they are non-recourse, which is a huge deal. Non-recourse means that if the deal goes completely sideways, the bank can only take the property back. They can't come after your personal house, your car, or your savings. The loan is secured by the asset itself, not by you personally. This is how the pros play the game at scale. But leverage, like jet fuel, must be handled with respect. It amplifies your gains, but it also amplifies your risk. If you buy a property with very thin cash flow, a low DSCR, and the market takes a downturn, vacancies could rise. Suddenly, your income drops, and you can no longer cover the mortgage payment. This is how investors get wiped out. Using debt wisely means always having a margin of safety. It means buying right, projecting your expenses conservatively, and stress testing your numbers. What happens if vacancy goes up 10%? Can I still pay the bills? Good debt is the tool that allows ordinary people to acquire extraordinary assets. It allows you to control a large, income-producing portfolio with a fraction of the total capital. It accelerates your path to financial freedom in a way that saving and investing in the stock market simply can't match. You have to learn the rules, speak the language of lenders, and respect the risk. But once you master it, you've unlocked the single most powerful wealth creation tool in real estate. You now understand that a great deal is one that generates enough income to make a lender feel safe. But that begs the question, how do you find these deals in the first place? And once you find a potential property, how do you tear it apart and analyze the numbers to know with confidence if it's a winner or a dud? That process, the art and science of underwriting, is where fortunes are made. And it's precisely what we're breaking down next. So, you've got the marketing package from the broker. It's glossy, it's beautiful, and it tells a story of incredible cash flow and endless potential. The numbers look fantastic. Too fantastic. This document, my friends, is not a financial report. It's a sales brochure. Your job, the one skill that separates successful investors from hopeful gamblers, is to become a financial detective. You need to take their story and find the truth. This process is called underwriting, and it's where you make your money. Not on closing day, not when you renovate, but right here, right now, in front of a spreadsheet. Underwriting is simply the process of verifying a property's income and expenses to determine its actual profitability, and therefore, its true value. You're stress testing the deal. You're looking for the cracks in the foundation before you ever sign a contract. It all starts with two key documents you must get from the seller: the trailing 12-month profit and loss statement, or T12, and the current rent roll. If a seller is hesitant to provide these, that's your first giant red flag. The T12 shows you the property's actual, historical performance over the last year. Not projections, not hopes, but what really happened. The rent roll is a snapshot of right now. A detailed list of every unit, the tenant's name, their lease start and end dates, their monthly rent, and any security deposits. These two documents are your source of truth. Let's break this down into the two sides of the financial coin: income and expenses. First, let's talk about income. The big number you'll see on the marketing package is the gross potential rent, or GPR. This is the fantasy number. It's what the property would earn if every single unit was rented, every single day of the year, at the full market rate. But we live in the real world. Units are empty between tenants. Sometimes you have to offer a free month's rent to get someone to sign a lease. This is called vacancy and concessions. The broker might say the property has a 3% vacancy rate. Don't just believe them. Look at the rent roll. Are there empty units right now? Call other apartment buildings in the neighborhood and ask what their vacancy is. Check with property managers in the area. A more realistic, conservative number for your underwriting is often 5% or even higher, depending on the market. You are building your model, not using theirs. Next, look at other income. This could be from laundry machines, parking spaces, pet fees, or late fees. Is it consistent on the T12? If the seller is claiming $1,000 a month in late fees, that might sound good, but it's actually a sign of a bigger problem. Tenants who don't pay on time. That's not reliable income. It's a management headache. Be conservative and verify every dollar. Once you've tallied up the real rental income, subtracted your realistic vacancy rate, and added in the verifiable other income, you get a crucial number: the effective gross income, or EGI. This is the money you can actually expect to hit the bank account. This is your reality check top line. Now for the fun part, the part where sellers and brokers get creative. Let's talk about expenses. This is where you put on your detective hat. You need to go through the seller's T12 line by line and question everything. Let's start with the big ones. Property taxes. This is the single biggest mistake new investors make. The seller's T12 will show what they paid in property taxes last year. But guess what? The city or county is going to reassess the property's value based on your new, higher purchase price. Your property taxes will almost certainly go up, sometimes dramatically. You absolutely cannot use the seller's number. You need to call the local tax assessor's office, tell them your potential purchase price, and ask for an estimate of the new tax bill. Ignoring this can turn a great deal into a financial nightmare overnight. Next up, insurance. Again, don't use the seller's number. They might have a blanket policy or have been insured for years. You need to call your own insurance broker, give them the property details, and get a real quote for what your policy will cost. It will be different. Now for the most commonly manipulated expense: repairs and maintenance. A seller might show a suspiciously low number because they've been deferring maintenance to make the profits look better. They haven't fixed the leaky faucets, they haven't patched the potholes in the parking lot, and they've been crossing their fingers that the 25-year-old water heaters last one more year. You need to budget for reality. A good rule of thumb is to budget anywhere from $500 to $1,000 per unit, per year for maintenance, depending on the age and condition of the property. So for a 20-unit building, that's $10,000 to $20,000 a year easy. Does their number reflect that? Probably not. Then there's property management. The seller might be managing the property themselves to save money. Their T12 might show a 0 for this line item. You cannot do this in your underwriting. Even if you plan to manage it yourself, you must include a professional management fee. Typically 8 to 10% of your effective gross income. Why? 3 reasons. First, your time isn't free. Second, you might eventually want to hire a manager, and the expense needs to be in your budget. And third, and most importantly, when you go to sell the property, your buyer will absolutely underwrite for a management fee, which directly impacts the price they're willing to pay. You must account for it. Finally, the silent killer of profits: capital expenditures, or CapEx. These are the big, expensive, infrequent replacements. A new roof, a new parking lot, new HVAC units. These don't show up on a monthly profit and loss statement, but they are a very real cost of owning a building. If you don't set money aside for them, you'll be hit with a $50,000 bill for a new roof in year 3, and your entire cash flow for the year will be wiped out. Pros: set aside a replacement reserve every single month. A standard estimate is between $250 and $400 per unit per year. For that same 20-unit building, that's another $5,000 to $8,000 you need to subtract from your income annually. So let's put it all together. You take your realistic effective gross income, and you subtract all of your reality-checked, verified operating expenses, the new property taxes, your insurance quote, utilities, a real maintenance budget, a professional management fee, and your capital expenditure reserves. What you're left with is the single most important number in commercial real estate: the net operating income, or NOI. This number, your calculated conservative true NOI, is the pure, unlevered profit the property generates in a year. It's the heartbeat of the deal. And here is where the magic happens. The value of a commercial property isn't based on what a similar building down the street sold for. It's based directly on its NOI. The market values these properties using something called a capitalization rate, or cap rate. The cap rate is simply the NOI divided by the property's price. If a building has an NOI of $100,000 and it sells for $2 million, it's sold at a 5% cap rate. By looking at what other similar properties in the area have recently sold for, you can determine the market cap rate. Let's say it's 6%. Now you can take your underwritten NOI, not the broker's fantasy number, and use it to determine what you should pay. If your true detective work NOI is, say, $90,000, and the market cap rate is 6%, then the value of that property to you is $90,000 divided by 0.06. That equals $1.5 million. The seller might be asking for $1.8 million based on their inflated NOI. But your underwriting, your detective work, has just shown you the truth. It's a $1.5 million property. You just saved yourself $300,000. You've gone from being a price taker to a price maker. This is the power of underwriting. It's not just about running numbers. It's about uncovering the truth to build your own conviction and make offers with unshakable confidence. You've now stress-tested the deal. You've replaced their story with your facts. You've arrived at an NOI you can trust and a valuation that makes sense. You've found the deal within the deal. But now comes the next giant hurdle. How in the world do you actually buy it? Securing the financing for a multi-million-dollar asset isn't like getting a mortgage for a house. It's a whole different league, with different lenders, different rules, and different strategies that can make or break your entire investment. And learning how to master the art of the deal structure and secure commercial financing, that's how you truly scale. We're diving into that world next. When you step up from a 4-plex to a 5-unit property, you're not just adding another door. You're crossing a dimensional barrier. You're leaving the world of residential lending, with its familiar rules and standardized applications, and entering the entirely different universe of commercial finance. This isn't just a bigger loan. It's a different language, a different mindset, a different game. In residential lending, the bank is betting on you. Your W-2 income, your credit score, your personal debt. They're asking, can this person afford this house? But in the commercial world, the lender is betting on the property. They're looking at that 5-unit building or that 50-unit complex and asking a much more important question. Is this a profitable business? You are no longer just a borrower. You are the CEO of a new enterprise, and the loan application is your business plan. Your pitch. The lender is your first and most important investor. And they don't invest in hobbies. They invest in well-run businesses that generate predictable cash flow. So, who are these new investors? These gatekeepers of scale? They fall into a few key categories. First, you have the Titans, Fannie Mae and Freddie Mac. These are the government-sponsored enterprises, the big leagues. They offer some of the best terms you can find: long amortization periods, competitive interest rates, non-recourse debt, which means they can't come after your personal assets if the deal goes south. But getting a loan from them is like getting into Harvard. You need a great property, a strong market, and a stellar track record as an operator or a team that has one. They are the gold standard, but often not where you start. Then you have your local and regional banks. Think of them as the hometown heroes. They know the neighborhood, they understand the local economy, and they value relationships. A loan officer at a community bank might actually drive by your property. The terms might not be as glamorous as a Fannie Mae loan. You'll likely have a shorter amortization and it will almost certainly be a recourse loan, but they offer something invaluable: flexibility. They're often the perfect partner for your first few deals, especially if you can build a real face-to-face relationship. They're betting on the property, yes, but they're also still betting on you, the local operator. Next, you enter the world of Wall Street with CMBS loans, or conduit loans. This is where a bundle of commercial mortgages are packaged together and sold off to investors as bonds. It's complex, it's impersonal, and it's massive. These loans can offer great rates and high leverage, but they come with rigid rules and hefty prepayment penalties. You're not dealing with a loan officer. You're dealing with a servicer who is bound by a 1,000-page legal document. This is a tool for sophisticated investors on large, stabilized properties. And finally, you have the quiet giants, life insurance companies. They are the old money of commercial lending. They're conservative, patient, and incredibly selective. They don't lend on risky value-add projects. They want the best properties in the best markets, the trophy assets. If you can get a loan from a life insurance company, it's a badge of honor. They offer some of the best fixed-rate terms in the business because they're not looking for a quick win. They're looking for decades of stable returns. Understanding these players is just the beginning. The real magic, the art of the deal, lies in how you structure your proposal. It's about how you tell the story of your investment. This story is built on the holy trinity of commercial underwriting: the property, the market, and the sponsor. First, the property. The lender will demand to see the property's financial history, primarily the trailing 12-month profit and loss statement, or the T12. This is the property's report card. It shows every dollar that came in and every dollar that went out. But they're not just looking at the past, they're underwriting the future you're selling them. Your business plan has to be rock solid. You say you're going to raise rents by $200? You better have the market data, the rent comparables, to prove it's possible. You say you're going to cut expenses by installing LED lighting? You better have the contractor bids to back it up. Every claim must be supported by evidence. Second, the market. Why this city? Why this submarket? Why this street? You need to be the expert. You need to show the lender the story of job growth, population migration, and rental demand. You're not just buying a building. You're buying a small piece of a thriving local economy, and you need to prove to the lender that the tide of that economy is rising and will lift your boat with it. And third, the sponsor. That's you and your team. Lenders know that a great property in a great market can still fail with the bad operator. They will scrutinize your financial statement, your liquidity, and your net worth. But most importantly, they will look at your experience. If you're a beginner, this is where you panic. But you shouldn't, because you don't need to have the experience, you need to have access to the experience. This is where your team becomes your superpower. You might be new, but your property manager has a 20-year track record. You might have a smaller net worth, but you're partnering with someone who has a strong balance sheet. Your team's track record becomes your track record. You're selling the lender on the combined strength of your entire team. As the lender analyzes your story, they're going to use two key metrics to decide if it's a story they believe in. The first is the debt service coverage ratio, or DSCR. This sounds complicated, but it's incredibly simple. It's the property's breathing room. It measures how much of the property's income is left over after you pay the mortgage. If a property generates $125,000 in net operating income per year, and the total mortgage payments for the year are $100,000, your DSCR is 1.25. For every dollar you owe the bank, you're making $1.25. Lenders want to see that cushion. They want to know that if vacancies tick up slightly or an unexpected repair comes along, you can still easily make your payment. The second metric is loan-to-value, or LTV. This is simply the percentage of the property's price that the bank is willing to lend. If a bank offers 75% LTV on $1 million property, they'll lend you $750,000. The other $250,000 is your down payment, your skin in the game. The higher the risk the lender perceives in your deal, the lower the LTV they'll offer, forcing you to put more of your own cash into the deal. Mastering these concepts is how you get a yes from the bank. But the true masters of the game don't just get a yes. They create deal structures that are so compelling, they barely need a traditional bank at all. This is where creative financing comes in. Imagine you find a perfect property, but the owner, who's in their 70s, is worried about the massive capital gains tax bill they'll face if they sell. You could propose what's called seller financing. Instead of you going to a bank, the seller becomes the bank. You give them a down payment, and they carry a note for the rest of the purchase price. You pay them monthly just like a mortgage. Why would they do this? Because it solves their tax problem by spreading the income over many years, and it provides them with a steady, passive retirement income secured by a property they know and trust. It's a brilliant win-win. Or consider an assumable loan. In a rising interest rate environment, finding a property with an existing loan from a few years ago at a low, fixed interest rate is like finding a hidden treasure. If that loan is assumable, you can literally take over the seller's existing mortgage, inheriting their fantastic terms. This one strategy can fundamentally change the profitability of a deal, making an average deal a grand slam. This is the art of the deal. It's about understanding everyone's motivations. It's about looking beyond the spreadsheet and seeing the human element. The seller who wants a simple retirement. The lender who wants to minimize risk. You, the investor who wants to create wealth. The best deal structures aren't adversarial. They're collaborative solutions that solve problems for everyone involved. Securing your first commercial loan is a rite of passage. It's the moment the financial world officially recognizes you not just as an individual, But as a professional real estate investor, a CEO, the package you submit, the story you tell, the team you assemble, it's the culmination of all your research and preparation. And when that commitment letter from the lender finally hits your inbox, it's a feeling unlike any other. It's the green light. It's the validation that your vision is not just a dream, but a bankable business plan. You've got the financing, the deal is structured, you're at the finish line. But getting the keys is just the beginning. The real work and the real wealth generation starts the day after you close. Because now, you have to actually run the business. And managing a multifamily property, executing on that business plan you sold the lender on, that is a completely different beast. We're going to tame it in our final part. So let's talk about what it means to truly be in the driver's seat. Because the day you close on your first multifamily property, the celebration is short-lived. The real work, the place where fortunes are truly made or lost, begins right now. This is asset management, and it's the engine that powers your entire investment. It's a machine with 3 critical components: managing your tenants, managing the physical property, and managing the finances. Get these 3 right, and you're on the path to building serious wealth. Get them wrong, and you'll be the one getting a painful education. First, let's talk about the lifeblood of your property: the tenants. Never forget, you are not in the real estate business. You are in the people business. Your tenants aren't just numbers on a rent roll. They are customers paying for a home, a safe place to live. Your success is directly tied to their satisfaction. This starts with a rock-solid screening process. You want to find not just people who can pay, but people who will pay, and who will respect the property and their neighbors. This means credit checks, background checks, income verification, and actually calling their previous landlords. A bad tenant can cost you 10 times more in eviction costs, damages, and lost rent than a month of vacancy ever could. Once you have good tenants, your job is to keep them. Every time a tenant moves out, you lose. You have vacancy loss, turnover costs for painting and cleaning, and marketing expenses to find someone new. A happy long-term tenant is pure gold. This means being responsive. When they report a leaky faucet, you fix it promptly. When they have a concern, you listen. You're building a community, not just renting out boxes. This doesn't mean you have to be their best friend, but it does mean you must be a professional, respectful, and fair landlord. And when problems do arise, and they will, you handle them according to the lease and the law. You must know your local landlord-tenant laws inside and out, especially concerning evictions. An eviction is a last resort, a failure on some level, but sometimes it's a necessary business decision you must be prepared to make legally and efficiently. Next up is managing the physical asset, the building itself. This is where so many new investors stumble. They see a dripping pipe and think, "I'll get to it later." That later turns into a rotted floor, a collapsed ceiling, and a $50,000 problem that started as a $5 washer. There are 2 types of maintenance: reactive and proactive. Reactive is fixing things when they break. Proactive is preventing them from breaking in the first place. Your goal is to live in the proactive world. This means having a schedule. Gutters are cleaned twice a year. HVAC systems are serviced every spring and fall. You walk the property regularly, looking for small issues before they become catastrophic failures. You also need to plan for the big stuff, the capital expenditures or CapEx. A roof doesn't last forever. Neither does a water heater or a parking lot. These aren't monthly expenses. They are huge, periodic costs that will sink you if you're not prepared. This is why you must be setting aside money from day 1 into a replacement reserve account. Your lender will force you to do this, but you should be doing it for yourself anyway. A smart investor knows their roof has about 7 years of life left and starts budgeting for its replacement today, not in 6 years and 11 months. You'll also be managing vendors, plumbers, electricians, landscapers. You need a roster of reliable, insured, and reasonably priced professionals you can call on. Don't wait for an emergency to find a good plumber. Build those relationships now. The third pillar is managing the finances. This is the scoreboard. It tells you if you're winning or losing. It's non-negotiable. You need a separate bank account for your property. All income goes in, all expenses go out. No exceptions. This isn't just good practice. It's essential for liability protection and sanity at tax time. Your primary financial task is rent collection. You need a system that is clear, consistent, and easy for your tenants. Online portals are the gold standard now. They make it easy for tenants to pay and easy for you to track. And you must enforce your late fee policy. Every single time. The first time you let a late payment slide, you've just taught your tenant that the due date is merely a suggestion. Beyond rent, you're tracking every single penny of expenses. You're categorizing them. You're comparing them to the budget you created in your pro forma. Are your utility bills higher than you projected? Why? Is maintenance costing more? Find the root cause. This is how you run a business. You analyze the data. You look at your profit and loss statement every month. You see what's working, what isn't, and you make adjustments. Your pro forma wasn't just a document to get a loan. It was your battle plan. Now, you're in the field and you need to see if your plan is surviving contact with reality. Now, hearing all this, you might be thinking, this sounds like a full-time job. And you're right, it can be. Which leads to the single biggest operational decision you will make. Do you manage the property yourself? Or do you hire a third-party property management company? Self-managing is tempting. You save the management fee, which is typically 8 to 10% of the gross monthly rent. You have complete control and you will learn every single detail of your investment. This can be a great option if your property is small, you live nearby, and you have the time, the skills, and the temperament for it. But make no mistake, you will get calls at 2 a.m. about a clogged toilet. You will have to chase down rent. You will have to personally handle every single tenant dispute. If you're not careful, you won't own the property. The property will own you. Hiring a professional property manager, on the other hand, buys you two incredibly valuable things: expertise and time. A good PM company already has the systems in place. They have the tenant screening software, the vendor relationships, the legal knowledge, and the experience to handle problems you haven't even thought of yet. They act as a buffer between you and the tenants, which can be a huge relief. This allows you to focus on the bigger picture, analyzing the property's performance and finding the next deal. It turns your active investment into a more passive one. The downside, of course, is the cost. That fee comes directly off your bottom line. And a bad property manager can be a nightmare, neglecting your property and costing you far more than their fee. So if you do hire a manager, your job isn't over. You now have a new critically important job. You must manage the manager. You need to set clear expectations and key performance indicators, or KPIs. What's their target for vacancy rates? For rent collection? For the time it takes to turn over a unit? You should be getting detailed financial reports from them every single month, and you need to read them. You should have a standing call with them to go over performance. You are the CEO of your investment. They are your COO. You hired them to execute, but you are still in charge of the strategy and you are ultimately responsible for the results. All of this, the tenant management, the maintenance, the financial tracking, it all serves one purpose: to execute your business plan. Remember that value-add strategy we talked about? The plan to renovate units and raise rents? Management is how that plan becomes reality. It's the property manager who coordinates the contractors. It's the property manager who markets the newly renovated units at the higher rent. It's their leasing team that finds the qualified tenants willing to pay for a better product. Without excellent execution on the ground, the most brilliant business plan in the world is just a piece of paper. And this brings us full circle right back to your exit strategy. Because the quality of your management during your hold period directly determines the value of your asset when you go to sell or refinance. A buyer isn't just purchasing a building. They're purchasing a stabilized, income-producing business. They will pay a premium for a building with a low vacancy rate, a history of on-time rent collections, well-maintained systems, and happy long-term tenants. All of those things are a direct result of great management. Poor management, on the other hand, leaves a trail of destruction. High vacancy, deferred maintenance, and a chaotic rent roll that will slash your property's value and obliterate your returns. We've covered an immense amount of ground in this series. We started with nothing but an idea, the mindset to think bigger. We learned how to find deals, how to analyze them, how to finance them, and now how to run them like a true professional. You have the complete roadmap. You have more knowledge right now than 99% of people will ever have about building real wealth through real estate. But information alone is worthless. It's potential energy. The only thing that matters now is what you do with it. The only thing that can transform your life is action. Your journey doesn't end with this video, it begins. The excuses are gone. The path is clear. Take one small step today. Analyze one property on LoopNet. Call one commercial broker and introduce yourself. Join one local real estate meetup. The biggest risk you face is not buying the wrong property. It's being frozen by fear and never starting at all. You have the ability to build a future of financial freedom. to create a legacy for your family, to design a life on your own terms. The keys to the kingdom are in your hands. It's time to go build your empire.